I made my first million when I was 40 years old. It took me another 35 years to truly understand wealth. You want to know the difference between those 2 points in my life? You think it was some secret stock pick, some complex algorithm, some moment of genius. The difference was I stopped doing stupid things. That's it. That's the secret. The entire financial industry, the talking heads on television, the slick advisors in $1,000 suits, they are all built on one single premise, that you need them to find the secret. That there is a magic formula, a perfect time to buy, a hidden gem that only they can uncover for you. There is no secret. There is only a long and very expensive list of stupid mistakes. Your only job, your entire job, is to avoid that list. If you simply avoid the common pitfalls that devour everyone else, you cannot help but win. I've watched brilliant minds, surgeons, engineers, entrepreneurs, people far smarter than me, systematically destroy their own wealth over decades. They fall for the same handful of traps over and over again. These aren't just mistakes. They are financial sins. And they will cost you not just money, but decades of your life. Time you will never get back. Today, I am giving you that list. The 5 traps the financial industry sets for you every single day. The 5 sins they pray you will commit. And let me be clear, if you are currently guilty of even 2 of these, you are already 10 years behind where you should be. So listen closely. The first trap, the first financial sin. You are buying things you don't understand. This is insane, utterly and completely insane. It is the single most prevalent addiction in the investment world. My philosophy is painfully simple. If I cannot explain how an investment makes money on the back of a napkin to a 10-year-old child, I do not buy it. Ever. I don't care if it's pitched by a Nobel laureate. I don't care if it has a fancy Greek name. I don't care if everyone else is getting rich from it. I walk away. History is a graveyard of brilliant people who got seduced by complexity. Look at long-term capital management in 1998. You had 2 Nobel Prize-winning economists, the so-called smartest guys in the room, running a hedge fund. They built financial models so complex, so arcane, that they themselves didn't truly understand the risks they were taking. They were making leveraged bets on the convergence of bond yields. And for a while, they looked like gods. Then a little country called Russia defaulted on its debt. Something their models said was a near impossibility, and the entire multi-billion-dollar house of cards vaporized in a matter of weeks. They had to be bailed out by the Federal Reserve to prevent a global financial meltdown. The smartest guys in the room, wiped out by their own complexity. And yet, here you are. You spend 6 hours on the internet researching a $200 television, comparing refresh rates and pixel densities. But you will take your entire life savings, $50,000, $100,000, and you will hand it over for a structured asset-backed, collateralized debt obligation fund because the man in the suit gave you a glossy brochure with a nice chart on it. You have no idea what's inside it. You have no idea how it makes money. You have no idea how it could possibly lose money. You are driving blindfolded at 100 miles an hour. Here is your rule, your test. For every single thing you own, take out a piece of paper and answer this question in 1 sentence. This investment makes money when. If you can't finish that sentence with absolute clarity, you are in danger. Here is your homework. Go through your portfolio tonight. Find the one investment you understand the least, the one that makes you feel a little bit dumb when you try to explain it. And tomorrow morning, sell it. I don't care if it's up or down. Get it out of your life. The clarity you gain will be worth more than any potential return. The second trap is the action trap. You believe that activity equals progress. Wrong. Completely and fundamentally wrong. This is the siren song of Wall Street. This is what they want you to believe. Because every time you buy, every time you sell, a little bell rings in their office. Cha-ching. A commission, a fee, a spread. My whole career, my entire fortune, was not built on frantic activity. It was built on long periods of absolute boredom. The big money is not made in the buying or the selling. It's made in the waiting, in the sitting. We call it sit on your ass investing. You find a truly wonderful business, you buy it at a fair price, and then you do the hardest thing in the world. Nothing. Do you remember the dot-com bubble? From 1998 to 2000, the whole world went mad. Day trading was a national sport. People were quitting their jobs to trade tech stocks from their basements. They were heroes. They were on the news. They were active. My God, were they active. Buying in the morning, selling in the afternoon, and then March of 2000 arrived. The NASDAQ, which had been a rocket ship to the moon, lost almost 80% of its value. Those day traders, the active ones, they weren't just poor, they were annihilated. Their life savings, gone. Meanwhile, the person who bought shares in a solid, boring company like Coca-Cola or Johnson & Johnson in 1995 and just went on vacation for 10 years, they came back a multimillionaire. But you can't help yourself. You check your portfolio 3 times a day. You see a red number and your stomach clenches. You see a green number and you feel a jolt of greed. You're not an investor. You're a gambler pulling a slot machine lever. And the dirty secret is that the casino, the brokerage house, they don't care if you win or lose. They get paid for every pull of that lever. They want you to be active. They need you to be emotional. Your anxiety is their business model. Here is your new rule. Warren Buffett calls it the 20-slot punch card. Imagine that when you are born, you are given a card with only 20 punches on it. And each time you make an investment decision in your entire life, you have to punch a hole. Once you've used all 20, you're done. You can't make any more. Suddenly, you'd be a lot more careful, wouldn't you? You wouldn't be trading some meme stock because you saw a rocket emoji on the internet. You would wait and wait and wait for a true no-brainer opportunity. You would think like a business owner, not a gambler. Your homework is simple. Delete the stock market app from your phone right now for 30 days. Don't look at it. I promise you, the world will not end. Your portfolio will be fine. But you will break the addiction to action. You will start to think in years and decades, not minutes and hours. The third financial sin is the forecast trap. You are listening to predictions. This one just makes me sad. It's a circus, a complete and utter charade, and people fall for it every single day. Let me tell you something. In my entire life, I have never once made an investment decision based on a forecast from an economist or a market strategist. Not once. Because they are in the business of entertainment, not the business of being right. Their job is to sound confident on television. That's it. Let's go back to 2007. The housing market was roaring. The stock market was at all-time highs. The so-called experts, the economists at the big banks, the heads of the ratings agencies, the Federal Reserve Chairman himself, they were all on television telling you the fundamentals were strong. They told you a nationwide decline in housing prices was a fantasy. Then Bernanke, the Fed chairman, famously said the problems in the subprime mortgage market were contained. Months later, the entire global financial system was on the verge of absolute collapse. The experts didn't just get it wrong, they got it catastrophically, apocalyptically wrong. They didn't see the biggest financial crisis since the Great Depression coming when it was staring them right in the face. And you turn on the financial news, and some guy in a sharp suit says the S&P 500 is going to 5,000 by year end, so you feel good. The next day, a different guy in an equally sharp suit says a recession is coming, and the market is going to crash 30%. So you feel terrified. You are a leaf in the wind, blown around by the hot air of people who have zero accountability and whose predictions are worth less than the electricity used to broadcast them. Here is your rule. It will change your life. Stop asking, what is the market going to do? It is an unanswerable question. Instead, ask these two questions. Is this a wonderful business? And can I buy it at a sensible price? That's it. One of these things is unknowable, a guess about the future. The other is knowable, an analysis of the present. Focus on what you can know. Your homework for this week: get a notebook. Every time you hear or read a specific market prediction, the market will do X by date Y, write it down, and write down who said it. A month from now, go back and look at your list. 6 months from now, look at it again. When you see the graveyard of failed predictions in your own handwriting, you will become immune to the noise forever. The fourth trap. This one is subtle. It's the safety trap, also known as diversification. You believe that owning hundreds of different stocks in a mutual fund makes you safe. It's a lie. It's a comfortable, profitable lie for the fund industry, but it's a lie nonetheless. It does not make you safe. It makes you mediocre. It guarantees you will never do much better or much worse than the average. It is protection from ruin, but it is also a fortress against ever getting truly wealthy. My partner and I, we would much rather own a significant stake in 3 truly outstanding businesses that we understand inside and out than own a tiny sliver of 500 mediocre ones we know nothing about. That, to me, is the definition of risk. Owning things you don't understand. Why diversification is only required when investors do not understand what they are doing. The history of the mutual fund industry is the history of this failure. For decades, star managers were celebrated. They ran funds with hundreds of holdings. They were on the covers of magazines. And yet, study after study after study has proven that over any long-term period, the vast majority of these highly paid active managers fail to beat a simple, dumb, low-cost S&P 500 index fund. They are essentially closet indexers. They own a little bit of everything, so their performance never strays too far from the benchmark, while charging you exorbitant fees for the privilege of delivering this guaranteed mediocrity. You've been sold this idea that diversification is a shield, but in their hands it's a blanket. It smothers your 1 or 2 truly great ideas with a pile of 50 bad ones and 150 forgettable ones. It's protection from winning. Here is your rule. If you cannot name your top 5 largest investments from memory and explain in a simple sentence why you own each one, you are not diversified. You are disorganized. Your homework: log into your retirement account, look at the biggest mutual fund you own, go to its page and find the list of its top 10 holdings. Read the names of those 10 companies. Ask yourself, if I had the cash today, would I choose to buy these 10 businesses? If the answer is no, then why in God's name are you paying a manager a handsome salary to own them for you? And that brings us to the 5th and final trap, the deadliest of them all, the fee trap. You are ignoring the small, silent, invisible fees that are eating you alive. This, this is the industry's dirtiest secret. Because it's not a secret about picking stocks. It's a secret about simple, brutal, undeniable mathematics. It is a mathematical certainty that guarantees you will underperform. I spend almost none of my time trying to be brilliant. I spend an enormous amount of my time trying to avoid being an idiot. And the single easiest way to be an idiot in finance is to voluntarily give away a significant portion of your returns for nothing. Think about the standard 2 and 20 model for a hedge fund. They charge you 2% of your total assets every single year, whether they make you money or lose you money, and then they take 20% of any profits. Or consider the average mutual fund charging 1% or 1.5% per year. It sounds small, it sounds insignificant, and that is the genius of their marketing. But it is a cancer. Let's do the math. If you have $100,000 and the market returns 8% per year for 30 years, you will end up with just over $1 million. But if you pay a 2% fee every year, your return is only 6%. At the end of 30 years, you will have just $574,000. The fees didn't just cost you 2% a year. They cost you almost half of your final nest egg. Half. Gone. Transferred from your pocket to theirs. For what? For performance that likely didn't even beat the market in the first place. You will drive across town to save 10 cents a gallon on gas. You will spend an hour clipping coupons to save $20 at the grocery store. But you will happily, blindly, pay a fee of thousands or tens of thousands of dollars every single year on your life savings without even blinking. It is financial madness. Here is your rule. Invert. Always invert. Don't ask, how can I make 10%? Ask, what is the surest way to guarantee I will lose money? And the surest way is to pay high fees. It is a guaranteed, unrecoverable loss before you even start. Your homework is urgent. As soon as this is over, log into every single investment account you have. Find the expense ratio for every single fund. Write it down. If it starts with 1 point anything, you have a fire in your house. If it's below 0.5%, you're on the right track. If it's below 0.1%, you're a professional. Fix this. This is not optional. So there you have it. The 5 traps. The complexity trap. The action trap. The forecast trap. The diversification trap. And the fee trap. The secret to wealth isn't finding the next great thing. It's just diligently, patiently, avoiding this list of stupid. You do this, you avoid these 5 sins, and you will not get rich next year. I can promise you that. There will be no wild stories to tell at cocktail parties. It will be boring. But in 20 years, in 30 years, you will look around at your friends and colleagues who chased the hot tips, paid the high fees, and listened to the gurus, and you will be standing on a mountain of wealth. You will have won the game, not by being a genius, but simply by refusing to be a sucker. Most people have already clicked away from this. They're gone. Their attention spans are too short. They're already searching for top 5 stocks to buy now. If you are still listening, it means you're serious. It means you are in the small minority of people who are willing to do the hard, boring work that actually builds wealth. There is no hype on this channel. There are no predictions, no get-rich-quick schemes, just the timeless, ironclad principles of not being an idiot with your money. If that sounds like a game you want to play, then subscribe. Because we are just getting started. All right, that's enough from me. Go be patiently, boringly rich.